Welcome to Limit Up, the weekly capital market podcast. My name is Don Collins. I'm a chartered accountant and business advisor of 30 years and a partner at Findex, a leading financial advisory and accounting services firm based in Australia and New Zealand. I'm here today with Ian Reynolds, trader, investor, former bank foreign exchange market maker, early investor in Bitcoin and tech founder. Welcome, Ian, to today's session.
Hi, Don.
Making money in stressed capital markets is tough. A typical investment portfolio will often fail. The world is moving into really challenging times as the US tries to address $39 trillion in debt, contradictory fiscal and monetary policy, internal conflict, and numerous wars. And the rest of the world tries to consider a new global reserve currency, a multipolar world, and aging demographics. So how can we understand what's going on in geopolitics and macroeconomics? Today, Ian is here with the latest press release from Siberia Capital. Ian, Liquidity Trap and Google pushes markets too hard. Can you provide us more detail on that?
Yeah, so last week we discussed the US IPOs, the long line of them, with SpaceX obviously at the forefront of it. And since that was announced, Google have snuck in with a $80 billion share offering, one of the biggest in history. So making that situation even worse. And we've seen on Friday, big drawdown in US equity markets, which we'll take a look at in a minute. But we've also seen Bitcoin, Ethereum, gold and silver move sharply lower. And journalists who need to find a story behind this, it's war and all this stuff. But in reality, I think it's retail investors go, we've had a massive run on, chip stocks or whatever it is they're in. And now we want to be in SpaceX, maximum greed. So let's sell the old positions and get into new positions. But there isn't the liquidity to do it. So everything's moving lower when, maybe it shouldn't. But it's really all about, probably $2 trillion. I know it says $1 trillion, but in reality, you'll probably $2 trillion in all the IPOs when we add them all up at the end, because there are bound to be some that haven't even been announced yet. And the $5 trillion of government debt rolling over, that's actually a very conservative number because they'll be issuing new debt as well. So a staggering amount of money has to be found somewhere to buy all this stuff.
So this creates a massive drain on the capital and limits the market's ability to absorb unexpected shocks. So how does that sort of react, or how does that work?
Well, firstly, it's all paper profits until it's real profits. And when you think about it, if the stock market, if nothing else happens and the stock market goes up 10%, you've actually created all that money out of nothing, haven't you? So it's like printing money, like the central bank printing money, but that can go away quickly. So the problem we have now is that Wall Street needs to raise 2 billion, 2 trillion. I'm even getting confused with the numbers myself, in the next 6 months from mostly retail investors, I'm thinking. And for that to happen, those retail investors have got to sell other investments. So, and there is liquidity or illiquidity at any time in markets, and it's not coming at a very good time. And, the market speaks for itself.
From your perspective, what are the sort of warning signs that global liquidity is drying up under this debt load?
Well, firstly, on Friday, Micron went down 13%. So this is a stock that's been going crazy. When you go down 13% with no news out, it's illiquidity. And it's retail only because no institutions are buying at these crazy levels. So it's retail chasing the price around, and they're not strategic traders like professionals are. So, and you're seeing more institutional investors sell gold and silver, maybe central banks, maybe sovereign wealth funds, to fund the now higher level of oil. So we were in the 65s, let's say we're in the 95s now for the sake of argument. Liquidity is here at country, supranational and local level, because central banks haven't been printing any money recently. The Fed has been buying bills to help out the federal government, but we haven't had what everyone was suggesting, which was central banks printing money and giving it away like we used to.
Yep. You outlined in your announcement, obviously with Google's equity announcement. So why does that announcement trigger such a big sell-off in the cryptocurrency, and then obviously a drop in the Nasdaq by 4%?
Well, I think it was just the last straw. We've got all these other things coming up, and we know that SpaceX is on the 12th, and suddenly Google's got in with an equal size offering in front of them. It's doubled the burden. That money has to come from somewhere, and crypto is the first. Obviously, as usual, crypto is the one to react first because it's where the loosest money is.
Yep. Okay. You also touched in your announcement about the US and Iran ceasefire and the drone strikes targeting the Strait of Hormuz. You also outlined about gold and silver falling, US dollar strengthening. Why did the precious metals not fail to act as a safe haven this time?
Because the people that have been buying tech stocks have also been buying gold and silver. If you remember, Bitcoin went first, gold and silver went second, and equities went third. So if you remember the parabolic moves in gold, where every man and his dog was buying gold coins and everything like crazy, it's more illiquid market to sell. If you go and buy some bars of silver, trying to sell it is really difficult in normal times because the dealers offer you bad prices. You've got to lug all that silver around somewhere. You can't just press a button. You've got to go and do it physically. So it's not so easy. The dollar has been higher because of the war, which obviously puts pressure on anything related to it, i.e. gold and silver in this case, and Bitcoin, of course. So there's lots of things that have been not helping. The numbers on Friday, non-farm payroll, was stronger than expected. So the narrative that everyone's trying to grasp that rates are going to go lower doesn't seem to be likely.
No, it was a question I had. Thank you. Is that economic strength? What does that mean for the central banks with in relation to interest rates, and will they keep them high for longer?
Well, it seems as though Europe is going to hike rates this Thursday, because they've been talking about it in public.
Right.
We know Australia's already been doing it and is going to go again. I think it's the week after. FOMC is next week, first for Kevin Walsh. Inflation is ticking higher. CPI is on Tuesday, so that will be interesting. In a normal situation, the Fed would be hiking rates.
Yes.
But politically, that's not a good idea, according to Trump.
No. No.
But in reality, all these markets are at huge highs, and they're looking for cheaper money or the continuation of cheap money to keep people borrowing to invest. And if that changes, then there's going to be a big crash in all of those leveraged assets. Yep.
Very good. Was there anything else out of your press release you wanted to talk through?
Only this morning I saw Iran firing ballistic missiles at Israel. So any pretense that there's a ceasefire is just rubbish, right? And it's just I suspect the US is actually going to try and get out of it now because it's it's done all it could and is in fact making things worse all the time.
Yep. Okay. So on the back of that, and you've just spoken about changes in prices, equities, etc. How about we go through your charts this week?
Alrighty, let's do it. Let me just find it. Here we go. Tell me when you can see it.
I can see it. Thank you.
So this is Bitcoin since 2020. And currently we are down 50% from the high at, let's say, 62,000, 63,000 with a high of 126,000. So lots of people keep trying to tell me, oh, it's too low. It's, it's got to go up. But if we look at high to low from 2017 to 2021, it dropped 86% from 19,000 to 3,000. The 4-year cycle which hit the high in October 21, and the low of 15,000, it dropped 78%. So we are now in the first year of the bear phase of the Bitcoin cycle. This happens every 4 years, and we're only down 50%. Bitcoin currently 63,000, just to be exactly the same as other cycles, could go down to 28,000. But if you ask anybody, they go, oh, it will never go there, which is what they said at 15,000 and 3,000, right? So
yes.
Everybody is full of hopium and tries to fool themselves that this time is different, and it isn't, because it never is. So, this is my buy zone for Bitcoin. So I'm, beginning to think about buying. So I'm less negative than I was. Our fund bought some Ethereum on the move down at the weekend. So we've seen it get absolutely crushed. And the basis of that is that at some stage, all of these legacy markets are going to get tokenized. There's only one game in town, which is Ethereum.
Yep.
But it's like catching or falling life. You lose all your fingers. Gold, similar bad setup. We are now down 27% from that high of 5,600 to the low of 4,100. That was 27% drawdown. Quite a lot for gold. As you can see, this resistance line here, it keeps banging up against it and has just been rejected again. So we're rebuying gold in our fund around 4,100 and 3,500 if it gets there. And it's just all negative news. And you can see silver dropped out of its channel, hitting its 200-day moving average, all that sort of stuff. It's just everything is bad news for risk assets at the moment. Part of the blame is the dollar because of the war situation. Because why is that? Because everyone keeps saying that the dollar's going to nothing. Well, it still is the reserve currency, and everybody is still short of dollars because in the euro dollar market, i.e. dollars issued in Europe, which is not the same or part of the US banking system, everyone just issues US bonds and has to refinance them. So in time to danger, they buy dollars as a safe haven.
Yep.
Even if it's just the worst, just the best shirt in a bad laundry or whatever the metaphor is.
Yeah, best in a bad bunch. Yeah.
Anyway, you can see it's come down a lot, but it's not going down any further. And as we discussed last week, if I stick the line through the middle, let's go on, there we go. If we stick the line through the middle, actually probably hasn't gone anywhere since March. But that in itself is a change. Internet must have cut out. Bonds, rates pushing up again. We can see it above the downtrend channel on the US 10-year. We can see sterling rates pushing up. Chinese rates pushing lower. Canadian rates higher. Australian rates higher. And all the action was, of course, on equity markets, where we saw a massive 4% sell-off on the NASDAQ on Friday. So, for those who think it's the end of the world, you've just gone up 30% since April.
Exactly.
As it gets steeper and steeper,
yes,
the blow off top, it gets more and more volatile, and that's what we're seeing.
Of course.
Same with the S&P and Dow Jones. Dow Jones really, okay, went down on the day, but it's still hovering around the all-time highs. So that's about it for the charts at the moment. So risk assets getting hammered, dollar and rates going up, waiting for those IPOs.
Not unless there's another sneaky one that comes along that we're not aware of.
Don't say that.
Very interesting. And as we know, week on week, things can change very quickly. So thanks again for that analysis. Anything else before we sign off?
No, we went through the ECB and the Bank of Canada interest rate meetings this week. That's Wednesday and Thursday. US CPI, absolutely critical. If that keeps nudging higher, markets are going to get really uncertain because it upsets everything. Not just for bonds, for rates, i.e., but for equities. And it doesn't seem, with everything going down and not enough liquidity, what we don't need is another shock, because that could take everything down.
Yeah, absolutely. Agreed. Well, thanks again, Ian, for this week. For those listening, that's another wrap of this week's Limit Up podcast. This and previous podcasts can be located on the Siberia Capital website. Alternatively, you can subscribe by accessing the link at www.siberia.capital/contact. Ian, thanks again for this week, and thanks everyone for listening in.
Thanks, Don. See you next time.
Thanks. Cheers. Bye.
Cheers.